Now, in tonight's class, I'm going to intermix the term security. I might say the euro, I might say gold, but we're not talking about any specific instrument. We're talking about all publicly traded financial instruments in which an open market exists. I'm also going to intermix the terms investing and trading. We know the difference. If you're here from ETX, and that's why we're all here, we're traders. Investing takes a longer term position or is investing in the future. I know the difference, you know the difference, but it gets very boring just saying trading, trading, trading. So I mix up the terms, but we know what I'm talking about. So tonight, we're going to talk about one of the most important concepts that you need to understand in order to trade. And this is called trends and trend lines. These are the first things that you can put on a chart. And in my opinion, every trader, no matter how you're going to trade, what you're going to trade, what style of trading is, you need to be able to put some basic things on your charts to help you just understand what is going on. So we need to learn how to read charts, and that's what we have in our charting class. And if you attended our class last week, we talked about line charts, bar charts, and candlestick charts. And whether you're using a bar chart or a candlestick chart, they give you basically the same information, but we have to be able to identify the direction of the trend. And the oldest adage in this market is the trend is your friend. Okay. And then it goes to never trade against the trend. Now, why do people say that? You have people that always trade against the trend, but they're a special, not kind of person. There are special strategies you can have. You have to be a specialist to fly against trend. When a market is moving up, it takes a lot of energy for that market to continue up. Trying to pick little highs in that market for where you can jump in at a high price to sell real quickly at a low price, statistically, will not be as successful as trading with the market. And once all those traders have jumped the market, remember when you were a kid and you had a little hamster, and that hamster would get on that wheel and he'd huff and puff to get that wheel started. But once he got it started, that wheel was going round and round and round and round and round. And he would just keep on going endlessly. Well, this is what happens when a market starts moving in a trend. There's so many people jumping on that wheel and pushing it that way to try to be a counter trend trader is not statistically successful. Now, understanding when the trend is losing momentum, that's when that little hamster, his little feet are getting so tired and he's running out of energy, he's going to start slowing down. And we can see that that little wheel start moving a little bit slower. We know the trend is starting to slow down. We don't know how long he's going to be able to keep on going before he's exhausted, but at some point he's going to just stop. Or maybe his food is in the opposite direction. He's going to jump out and get some food and then start getting on that wheel in the opposite direction. And it's going to take him huffing and puffing, and he's going to get that wheel turning and turning and turning. That's a downtrend. Now, there's that intermediate where it's trading on the sideways trending. Okay, but when a market is trending, whether it's up or down, the old adage is the trend is your friend. So when the prevailing trend is up, why would you want to look for short entries when buying might result in much smoother trades? Many amateur traders, even when facing a long lasting trend that has been going on for months, can't stop trying to predict reversals. Whereas they could have made so much more money much simply by joining the trend. But even if you're not a trend following trader, you can combine the concept of trading with the higher time frame trends with your regular trading approach. First of all, being able to identify a trend. Now, we're not talking trend lines, but being able to identify a trend helps you understand where the pressure is in the markets. So we have short-term trend frames, short-term trends, long-term trends, medium-term trends. If you know a particular asset It is a long-term trend upward, but lately it's been coming down in price. So the short term is to fall, but the overall pressure is pushing it up. So you're getting perspective on the market. So let me show you on an actual chart. Oops. Now this is a chart of gold. Now, just looking, and a trend is something you just visually see. There are no mathematical calculations, no other we're not talking about trend lines. We're just, oh, hold on a second. For some reason I lost my screen here. Yeah, there we go. So a trend is just simply the direction. We've all heard lately that the car manufacturers are cutting out sedans, and more sales are on pickup trucks. So what is the trend? Pickup trucks are gaining, sedans are falling. Okay. Now, would we want to make an analysis of we're going to discontinue 4 sedans and add on new trucks? No, not with a whole bunch of analysis, not like just knowing some numbers. We want to do some evaluation. We want to understand if this is a short-term trend. Is it a medium-term trend? Has it been the trend going on for a long time? We can do that by looking at the chart. Now we're looking at gold, okay? And we can see currently gold is trading in a downtrend. It's had a significant drop from 1560, and now it's trading right now about 1498. That's a 60 some dollar drop. Okay? And that's been over since the 6th, let's say since the 5th of the month. So you would say there's a lot of pressure on gold to fall. Okay? And gold is falling, and the traders are jumping in to push the price down. That might be what you say. But if we were to go back and look at gold in a longer term chart, look at where gold is. Gold since May has been in a hardcore uptrend. Okay, where gold topped out at 1560. So this could be a simple correction. It can be, now price doesn't move in a straight direction. Price moves in a push and an ease, a push and an ease, a push and an ease. So this could be a simple ease. So if you were in the market trading gold to go up, you wouldn't panic at this point, because what you're looking for, a healthy trend, is moving and push, ease, push, ease, push, ease, push, ease. And you might just say, fine, because we might say in a trend, as long as it doesn't go below the prior lowest point, in other words, it pushed up and it eased back down, didn't go, or it doesn't fall back to the lowest point before the push, we're still safe, because what we're saying is, in the long run, this is still just a push up and an ease down, and then it's going to continue on with this rally. We're not sure, but this is in the longer term. Now, this is going on since June the 15th. So we now have our short term perspective, we have our medium term perspective. And if we were to go back farther, well, we can see that since 2013, gold has basically been trading in a sideways movement with no sure push in either way. Now we can again go back and see that gold, in another longer term trend all the way back to July, has been trading in a steep uptrend. Now there's no rules about this. What you're getting to know is the understanding the environment in which you're trading. You're getting to understand the temperamental part of your trading. You're getting to understand, and because what you have to get is perspective. If you had a child and you kept, like, a lot of parents do, inside the closet door, every time he grows taller, you put a little etch on the closet door, and you saw that Jimmy Bob was growing pretty steadily. Now, if you had gone to school with Jimmy Bob and you looked around at all the other students and you thought Jimmy Bob was jumping up on that marks in the closet, but you went to the school And you saw that all the other kids jumped up, and Jimmy Bob was a head shorter than the other guys. Well, Jimmy Bob wasn't doing as well as you thought he was. His growth was slower than the other people. On the other hand, if Jimmy Bob was heads above everybody else, you because what you do is you're getting perspective. Okay, you're getting some understanding. So we saw how gold is doing here. We saw how gold is doing in a shorter perspective, and we saw how gold is doing in the short term because we're only trading in a short term environment. Okay, because we're traders making short term trades. But in order to assess, in order to trade with the trend, environmental gives you an information. Going back to a long term trend gives you information. A medium term trend is deciding, it helps you decide whether you will buy, consider to buy or sell that asset. And then your short term is helps you determine at what price you're going to actually enter the market. But very few times do you make a trading decision when you're looking at a 15-minute chart. The 15-minute chart will help you decide what price you're willing to enter, where you put your stop loss. But this tells you we're in a very good uptrend. So you would be considering buying gold. But if you look back at where it was 2 hours ago, okay, we see that it's not such a strong uptrend. And we see a different perspective when we look back an hour. So in this 1 hour, we might be saying, oh, we don't have anything that's really decipherable. But at this point, it's dropped low enough, we might consider a buying opportunity because it's been in a long-term trend. You're just getting to understand. Trends have no rules or laws about them. Okay? It gives you some general knowledge by looking at multiple time frames and looking and understanding the personality of that asset. But then, in order to start trading, we have to then start applying some type of understanding to what price is trying to tell us. So once we've identified what the overall trend is, we have to then start putting something on our chart that will help us. And this is called a trend line. A trend line is rule based. Okay. And you could take any of those time frames and draw trend lines on it. So what a trend line does is it explains your price movement, your trend. Okay? Because an asset moving up or down, trending up or down, just tells you where it's going. Now, if you remember that markets are random and price is the only thing that you can depend on in a market, a trend line helps you find periods when the price is not random, when it is trading in a discernible pattern. And a trend line has rules and is actually drawn on your chart. Now, I mainly use trend lines to identify changes of established trends. When you have a strong trend and suddenly the trend line breaks, it can signal the transition into a new trend. Trend lines during ranges are ideal when it comes to finding breakout scenarios and when to enter, when a price is entering a trending mode. Also, trend lines can be combined with moving averages to nicely because they complement the characteristics. So trend lines are a useful tool to visually highlight a trend and potentially being part of a trading strategy. So a trend is a general view. It's not part of any strategy. Okay? It doesn't help you do anything but understand perspective and personality. A trend line starts to become part of a strategy, or it starts to define the market for you. Now, there's a lot of mis and inaccurate information about trend lines, though. Learning how to use trend lines effectively, if you're going to use them, is crucial so you don't fall into some of the common traps. Trend lines are a technical analysis tool used to define and project price trends in major markets. Trend lines have the potential to alert us when a pullback move, a move against direction is over or a trend is resuming. Now, remember when we looked on the gold chart and I told you that it might just be a correction when gold soared up. I told you peaks and valleys, and we saw it soar up to 1560. And now we're not sure whether it's a correction, a retracement, or a reversal. Now, a trend line will help you make that decision because a trend line helps you tell what prices it should return back to its normal movement. But remember, price is the ultimate indicator, though. Therefore, price action must always be considered when using trend lines. Trend lines are drawn on your chart to help predict the general direction of price. They also help you see reversals. Trend lines also help determine good entry and exit points, and you help you decide where to put your stops. Wow, they sound like they're magic lines, right? Well, not really. They are quite good, but like any form of analysis, if used alone, they won't make you many pips. However, they may make a great addition to your trading arsenal. They might point out prices where you should worry, prices where you shouldn't worry. They might tell you where to put your stop loss. They might help you interpret what the market's trying to tell you. The main problem with trend lines is placing them on your chart. It can be a little intimidating to start, but it is quite easy to get the hang of it. Now, the purpose of drawing trend lines is to identify where possible reversals will take place. They can also signal a change in the trend. In an uptrend, we draw the line along the lowest point in the trend without letting the line cross through prices. You need at least 2 touches of a trend line to be able to draw it. That's just put it on your chart. That doesn't mean it's an active or good trend line. So let's go over to our chart. And we're going to stick with this gold, and we're using a 15-minute chart. So what we're going to look for is a place that we can find, and you usually want to define where you put your chart by the swing low. We want to then find where we can put a line on our chart and an uptrend where it supports price above it, but no price has fallen below that trend line. You cannot break a trend line. When you do, that trend line is over and you'd have to redraw it at a new price. So now we want to put a line on our charts. So we click on our trend indicator and we would then come down here and we would pull a line out here. And that would be our current trend line. So we can then analyze where price had dipped. See how price had dipped all the way down? Remember the push, the ease, now it's back to push. Price fell all the way down here, but it stayed above that trend line. So we're pretty safe as price pushes up again because this will keep price above the trend line. As long as price stays above that trend line, that trend or that movement is still valid. So this is now if price breaks that trend line, that's when we need to start to worry. So because we should have push, ease, push, ease, push, ease, push, ease. And each time the ease comes back, should never come lower than that trend line. Now, the fact is, we were able to draw this trend line here, and it would become a good trend line when it had a second touch. So here's where the low touched that price again. Now, a trend line is a good trend line, but is not valid until it touches the trend line a third time. At this point, okay, when that low touched that trend line, we now have a valid trend line that we can use to predict future moves forward. Because you have lots of times that you put a line on a chart, it's got 2 points in common, but it's never validated. Price never comes back near that line again. So once it, and the more touches that it has, the more valid and the more crucial that trend line is. So now we have one touch, two touch, three touch, four touch. When we know this is a pretty good trend line, we can rely on it. Now, a trend line, once you draw it in your charts, actually stays on your charts. You can get rid of it, but it stays there. So if we were to change our time frame now back to a 2-hour chart, we can, this is that same trend line we drew, but now we're looking at a 2-hour. So now we actually see that in the current trend, and that's a beautiful trend and a beautiful trend line in perspective of how price is moving in a longer term. Now it gets smaller and smaller because we see more and more on chart. If we were to go back to a 4-hour chart, it's still right there. It's still holding. It's a beautiful trend line, but we see that price is actually trading in a congestion and in a mess between this price and this price. Okay, so if we were to say our support line was about here, and actually if we were to see resistance lines we drew from the past forward, our trend line would be continued up. We could actually delineate price points as price moves up that trend line and hits the resistance line of where we'd expect market action or reaction, where we would want to learn to understand or be prepared for something in the markets. So let's talk again about drawing a trend line. Now, this trend line on this graphic chart looks very much like the trend line we just drew over there. One was in reality and one was created by a graphic designer. So there are two main types of trends. We have bullish trends and bearish trends. They mirror each other, except a bearish trend and a downtrend is drawn over top of prices instead of underneath prices. So here we have our same line we did before. Took our swing low, extended it forward, found a second point in common. Now we projected this line in the future, but look at this, we have no touches. So therefore, this is not what we call a valid trend line at the moment. So a bearish trend line is formed by connecting two or more highs, and the second swing high must be lower than the first swing high. The trend is your friend, but like all friendships, it's a complicated one. Unless you understand the nature of a trend, your friendship is destined to fail. As any trader quickly realizes, there is a great deal more to trading successfully than merely identifying a securities trend and buying pullbacks in an uptrend and shorting bounces in a short trend. So let's begin with the basics. In an uptrend, or an uptrend is defined as a series of higher highs and higher lows. So in other words, as we're making that push up, we form a higher high. As we ease back down, we form a higher low. This is your low. We push back up and we form another higher high. Ease down, we form a higher low, and push back up. And if we were to drop a trend line, guess what? It would connect all those and give us. Now they don't always have to touch the trend line, but each time it falls to a low, it's going to make a higher low than the previous dip we had before. And a downtrend is defined as just the opposite. It's going to make lower lows and lower highs. Lower low, lower high, lower low. And then, of course, we have sideways trends or congestion. So those are the actual three types of trending markets. We have uptrends, downtrends, and sideways trends. There are two major obstacles that you will run into when attempting to apply traditional wisdom. First, not all trends are regular. In other words, while one type of support level may hold well in one uptrend, such as a popular 20-period moving average, in another trend it might only hold to 10. Now, Because we are only trying to determine or find in our trading high probability trades, we want to always look for well defined trends. That is a trend that's making higher highs and higher lows, moving in a non random type fashion. Because, see, you can have an uptrend where prices, because an uptrend means prices moving up, but you could have something like this where it's not necessarily making higher highs and higher lows. Okay? It's just kind of moving up, but it's moving up in a non-regular fashion. Well, when it's moving up in a non-regular fashion, you can look at something and say, well, I could have entered the market there and made a ton of money there. But ultimately, you couldn't have made a trading decision because you had nothing well defined. And because the market offers so many opportunities, we only want to trade when the risk is minimal. Risk is minimal when price is moving in a non random fashion. That means in a well defined trend. And that will help you get high probability trades. Doesn't help you make a winning trade, but it gets you high probability trades. And then you can apply your risk management because in a not when a market is trending in a non-random fashion, you can also set better entry points, exit points. You can put your stop loss better, and you can assess the volatility better, and you can determine where you put your stop losses and what your risk management requirements are. So you have to keep in mind that no trend lasts forever. At some point, an uptrend will become exhausted and will break through support instead of pulling back into a bounce, and then will continue higher once again. Without a solid understanding of how trends exhaust themselves and the tools for recognizing different types of exhaustion and how they affect the correction of a trend, you can easily find yourself on the wrong side of a market or jumping out of a market and missing the biggest part of the move. So most traders who pick up a book on technical analysis will run into the concept of trend formation or trend development, whereby the trends consist of a series of three waves of upside that are then punctuated by two small corrective waves. Templates for these trend developments are typically similar to what you see over here in the chart. Now, I personally don't look at waves or cycles. There's all types of advanced theory in Elliott wave fashions and all that kind of stuff. I just don't do it. I believe in the peaks and the pushes firmly. I believe in trend lines. I believe in a well-developed trend. But the theory of waves in a trend tries to predict how far that price movement will be in each wave. And there are equations that people use that wave two will be 1.5 times larger than wave one. Okay. I don't follow it all. I don't use it all. I'm not even sure that it's correct, but I do use trends, and trend lines help you define waves. Now, trend lines are one of the most used and misused tools in a trader's toolbox. If you're going to use them, you have to have consistent methodology that defines when you would draw them, where you will draw them, and what you would do when price touches them. Too many times I've seen traders draw random lines on their chart with the argument that they may not be using it, but it's good to have it there. I tend to disagree. If you don't have the specific rules, then you draw lines you wished for there, then rather than the ones that are actually there. And if you don't have the consistent rules and you're drawing these random lines on there saying, oh, it's good to have there anyway, well, it really doesn't. It just confuses the situation. And the reason I like trend lines is because they are rule based. It's one of the first things, or one of the few things that you actually have on your chart that is completely rule based. Most other things aren't. They're left up to your interpretation. I like starting something from a set of rules because if you imagine that you in Japan, Billy Bob over in Australia, Bradley in Los Angeles, all drew the same trend lines, saying, why is that important? Or why do I want the same lines and the same prices everybody else does? Well, if I understand what prices are important to the market and I understand where I can expect a market reaction. So, like when the trend line and support line cross each other, I'm going to expect some market action. Or when price falls down to the trend line, I'm expecting something to happen. It can break through the trend line or it can bounce off the trend line. If all the other traders are watching it, I know gold at 12 at 1560 will have a reaction. I don't know what that reaction will be, but I know I should get a reaction. And when I can see what that reaction is, I can then make decisions. But if my trend line was different than everybody else's, and I was expecting some reaction at 1249, didn't get any. So therefore, I'm making decisions based on the wrong trend line. I want to know that that one tool is what everybody else is watching, because then I can judge their reaction to start making my own determinations. So I expect something very consistent from the trend line. The main reason I will use a trend line is to delineate the conditions that define, the current trend of the market. If the trend line correctly defines those conditions, then penetrations of that trend line are very significant. So first, the trend line defines the limits of swings that compose the trend. So it's important to be sure that there are actually swings before you draw a line. Now, if you notice in this chart over here, we have lots of trend lines drawn on here. Now, you wouldn't necessarily leave them on your chart. But see, here we would have drawn our initial trend line here. Price broke that trend line. So that trend line is no longer valid. We would then draw our new trend line, and that trend would have been valid through this price movement. Once it's broken, that trend line doesn't exist anymore. It's invalidated. We can take it off our chart, and then we would extend it out. And we're continuously drawing new trend lines that explain the markets. And look at this. When we drew this one, we have price down, bounce off, it came back up, bounce off, came back. Then it broke it here. We then drew the new one, and look at each time it was respected here. But we're constantly adjusting those trend lines because we don't have numerous trend lines. What we have is the current trend line. The other ones are invalid. Once they become invalid, you can throw them in the trash, get them off your charts. But the only one that matters is because we can only trade this way forward. So this trend line that ended there has no validity to it. All that's valid to us right now is this current active trend line. So what are the basic easy rules? Once a trend line is placed, it has to have a third bounce for it to become active. Now that price finds support or resistance at that trend line, it should have trouble breaking that line. If the price does break that line, it usually means that the trend is over. So placing lines is pretty easy. All you have to do is identify two swing lows or two swing highs and draw a line joining them. There you have it. Now your chart has trend lines. Well, okay, but wait a minute. Even though you can place a trend line based on two swing highs and two swing lows, the trend line remains unconfirmed until it is hit a third time. So a lot of newbie traders say to me, I can draw a trend line everywhere and anywhere. Yeah, you can draw lots of them, but you'll never get a valid verifying one because you need to swing low, a second touch, and then that third low is your established price. So here we see here bounce off, moves up. So this is the same chart that's moving forward, comes back up. Now what happens is it breaks that trend line here. Okay. Now at that point, we expect something to happen in the market. Okay. It could bounce off and then continue back up, or it can tell us that that trend is over. So we're now prepared. We expected an action there. We got a breakthrough. Now we could look at volume. We could wait for the next candle. We could look at the next support levels. But now we know that this trend has been broken. So this trend line is no good anymore. And there's a good chance that the actual trend is over. So trend lines can be placed on any time frame, but they're more effective on longer time frames. And also, the longer a trend line is active, the stronger it gets. So remember, we always want to validate and verify. So too many traders want to draw what looks nice to them. And they will say, so what, it broke. It's holding and we're going to continue that forward. Once it's broken, that trend line is over. So the correct way to then draw this would then be to draw it here at the lowest price and continue it up. Because then it has a third chance of being touched and being validated. Drawing inaccurate trend lines is just a waste of your time. And we want to buy on bullish trend lines and we want to sell. We would not, we don't want to buy or sell. We would only consider bullish or buy scenarios based on however we're entering a trade when price is above the trend. We would only consider sell scenarios when price is declining or below a downtrend. Okay. So this keeps us trading in the direction of the trend and allows us to exploit those movements. So trading only in the direction trend will let us exploit potential trend line bounces as efficiently as possible. And while they won't always give us winning trades, the trades that are winners should give us more pips than if we had attempted to place trades against a trend. So coming full circle, trend lines are a very simple tool to use. You are connecting dots on a chart, but hopefully the 3 tips I gave you to draw trend lines will take you to the next level. Now make sure that the trend line you draw are connecting 2 or more highs or 2 or more lows, but have not been broken by the price between those points. Remember to look for a third bounce to validate the trend line. Also make sure that you are taking advantage of trading with the trend by looking for buys in bullish markets and sells in bearish markets. So whether you use trend lines or indicators, price action is what ultimately determines how much money we make. Learning about price action, how trends move is never a bad idea. Once we understand the basic concept of how price moves, then trend lines become a more effective tool in helping us analyze the market. And if you believe my philosophy that price is always the final dictator and price is completely random. Price has no rules. It's completely random. But in these there are certain time periods in price that it starts moving in a non-random fashion. If we can find those non-random times of price movement, we can then start applying rules and make educated high probability trades. And these non-random times are when price is moving in a well-defined qualified trend. Okay. And when we have this well-defined trend, we have non-random price movement. It's the short gaps that price is actually moving in some type of something we can explain and apply. So understanding how to use trends and put them on charts is some of the best thing you do. And anything you do on a chart falls in the field of technical analysis. So whether you're going to use technical analysis or not, everybody should be able to look at a chart, put a trend line on a chart, put their levels of support and resistance, and then you can decide however you're going to use for trade. But these are your basics that everybody should be